Hey there! Let me start with something that feels illegal. The economy feels terrible. Rent is up. Food is expensive. People are stressed. And meanwhile, the stock market is like, best day ever. How? How can life feel worse while the market throws a party? Are stocks gaslighting us? Let's meet Alice. Alice wakes up, checks the news, and sighs. Layoffs. Higher prices. Another article about how things are tough right now. She checks her bank account. Not great. Then, out of curiosity, she opens a stock app. Green arrows. New highs. Celebration emojis. Alice stares at her phone and says out loud, "Who is this market for?" Great question. Because the first thing to understand is this: the stock market is not the economy. They're related. They talk, but they live in different houses. The economy is how people live today: jobs, wages, rent, groceries. The stock market is how investors think companies will do tomorrow. And tomorrow can mean 6 months, 5 years, or forever. So already they're not looking at the same thing. Now let's bring in Bob. Bob is an investor. Bob does not buy today. Bob buys expectations. Bob asks questions like, will this company make more money in the future? Will costs go down? Will competitors die first? Bob is weird like that. So when life gets worse for Alice, Bob doesn't automatically panic. In fact, sometimes Bob smiles. Because bad times do strange things. Let's say the economy slows down. People spend less. Businesses struggle. Some companies fail. Sounds bad. But for the companies that survive, they cut costs. Lay off workers. Close weak locations. Automate more. From a human perspective, that's painful. From a profit perspective, margins improve. So while Alice sees suffering, Bob sees efficiency. That's uncomfortable, but it's real. Now let's talk about interest rates. This is a big one. When life gets worse, governments and central banks panic. They want to stop the bleeding. So they lower interest rates or pump money into the system. Cheap money. And cheap money loves the stock market. Why? Because stocks compete with other places to put money: savings accounts, bonds, cash. When interest rates are low, those alternatives look boring. So money flows into stocks, even if the real world feels shaky. It's not optimism, it's math. Now here's another thing Alice doesn't realize. Most people don't own many stocks, but institutions do. Pension funds, insurance companies, big investment firms, they have to invest. They don't get to sit out because vibes are bad. So every month, money flows into the market automatically. Paychecks, retirement funds, stocks. Even during recessions. Sometimes especially during recessions because prices are on sale. Now let's talk about something sneaky: indexes. When you hear the market is up, you're usually hearing about an index, an average. And averages lie. If 5 giant companies do great while hundreds of smaller ones struggle, the index can still rise. Alice might see layoffs everywhere. But if a few mega companies are crushing it, tech, energy, finance, the market looks healthy. So the market can be up even while many people are down. Now let's talk about expectations again. The stock market is forward-looking. Always. If things are bad now but expected to improve later, stocks go up. If things are good now but expected to get worse, stocks go down. That's why markets often rise before the economy recovers and fall before a recession officially starts. It's not reacting to headlines. It's reacting to guesses about the future. Educated guesses, sometimes very wrong guesses. Now here's the part that really messes with Alice. Bad news can be good news. If inflation is high and unemployment rises, that's bad for people. But it might mean interest rates will come down sooner, which is good for stocks. So the market cheers while people struggle, not because it hates people, but because it's playing a different game. Now let's add one more layer. The stock market is not about fairness. It's about ownership. When you buy a stock, you own a piece of a company. If that company finds ways to make money even in bad times, you win. That company might raise prices, cut staff, expand globally. Again, painful for some, profitable for owners. So the market reflects the experience of owners, not workers. That's a huge disconnect. Now let's talk about inflation one more time. When prices rise, companies often raise prices too, sometimes faster than their costs, which means profits go up. So inflation that hurts Alice can boost earnings, and earnings drive stock prices. This is why the market can rise even when life feels expensive. Now pause. Let this sink in. The stock market going up does not mean people are doing well. It means expected profits are rising or money has nowhere else to go. That's it. No moral judgment, no happiness meter, just capital flowing to expected returns. Now Alice looks at the market again and feels something new. Not confusion, distance. She realizes the market isn't lying. It's just not talking about her. It's talking about future cash flows, discount rates, corporate survival, which explains a lot. And it leads to a more uncomfortable realization. The stock market going up can actually be a symptom of inequality. When fewer people own assets, asset prices can rise even as most people struggle. The market floats above daily life, connected but not grounded. And this is where Alice finally asks the right question. Not why is the market up, but what exactly is the market measuring? Because once you answer that, the mystery starts to disappear. The stock market isn't a scoreboard for society. It's a pricing engine for future ownership claims. And once you see it that way, it becomes clear why it can cheer while life feels heavy. And why the real issue isn't that the market is wrong, but that we keep expecting it to reflect something it was never built to measure. And that opens up a much bigger conversation about who the market actually serves and what happens when most people live outside of it. And what happens when most people live outside of it. Because here's the quiet truth no one tells Alice. The stock market doesn't care how many people are struggling today. It cares how much profit will exist tomorrow. That sounds cold, but it's not personal. It's mechanical. Now think about this. When life gets worse, people spend less on extras. Restaurants struggle. Small shops suffer. Local services feel pain. But giant companies? They have options. They raise prices. They cut costs. They fire workers. They automate. They move operations. So while Alice feels pressure, big corporations adapt, and markets love adaptation. Now let's talk about something weird that happens in bad times. Fear. When fear hits, investors don't stop investing. They rearrange. Money runs away from weak companies and hides in strong ones. So a crisis doesn't shrink the market evenly. It concentrates it. A few big companies grow even bigger. Indexes rise. The average looks fine. Meanwhile, entire sectors get wiped out quietly. Alice sees closed shops. The market sees consolidation. Same event, different lens. Now let's bring Bob back. Bob owns stocks, but Bob doesn't own everything. He owns the companies that survive. So when things get worse, Bob doesn't feel optimistic about life. He feels optimistic about relative advantage. Sure, Bob thinks, things are bad, but my companies will be the last ones standing. That's what the market prices. Survival, dominance. Now let's add another layer, global money. The stock market you see isn't just local money, it's global. When things get worse in one country, money doesn't disappear, it moves. Foreign investors look for safety, stability, strong currencies, and often they land in major stock markets. So while Alice feels squeezed locally, global capital flows in. The market goes up. Again, not optimism, positioning. Now let's talk about inflation again because it keeps showing up like an uninvited guest. When inflation rises, cash loses value. So investors look for places that can outpace inflation, companies that can raise prices, assets that grow with inflation. Stocks become ahead. So while inflation hurts daily life, it pushes money into the market. Pain for consumers, fuel for asset prices. Now here's the part that really breaks Alice's brain. Bad economic news can delay good news. If the economy is weak, central banks hesitate to raise rates or they cut them. Low rates are rocket fuel for stocks. So the worse things look, the more support markets expect. This creates a strange loop. Markets rise because they expect help because things are bad, which makes it feel like the market is cheering misery. It's not cheering misery, it's pricing policy reactions. Now let's talk about time again, because this is everything. Alice lives month to month, rent, bills, food. The stock market lives in years, decades. If life is worse now but expected to recover later, stocks rise now. Alice feels the pain now and relief later. Markets feel relief now and don't care about today. Different clock. Now let's talk about ownership again. Most people interact with the economy as workers. The market interacts with the economy as owners. Workers feel costs first. Owners feel profits later. So when companies cut jobs, workers hurt immediately. Owners see future savings. The market prices future savings. That's the disconnect. And it's uncomfortable. But it explains everything. Now here's something important. The stock market going up doesn't mean investors think people are happy. It means they think companies will extract value from efficiency, from pricing power, from scale. The market isn't a happiness index. It's a profit expectation machine. Now Alice starts to see the pattern. Every time life feels harder, the market looks further ahead. Every time she struggles today, investors focus on tomorrow. And that's when Alice realizes why watching the market during hard times feels insulting. It feels like someone celebrating while you're carrying groceries uphill. But the celebration isn't about the hill. It's about the view from the top. Now let's be honest. This system has consequences. When asset prices rise faster than wages, inequality grows. People who own assets feel richer. People who don't feel left behind. The market going up can make society feel more divided because success looks disconnected from effort. And that's where frustration turns into anger. People say the system is rigged. Sometimes that's exaggeration. Sometimes it's not entirely wrong. Because the system rewards ownership, not participation. And markets reflect that. Now here's the twist. The stock market going up during hard times isn't proof that everything is fine. It's often a warning, a sign that money is flowing upward while pressure builds below. Markets can stay high while society gets fragile. History shows this over and over. The market isn't a thermometer for social health. It's a price tag on future profits. And those profits can exist even when life feels worse. Now Alice asks the final question. Should I care about the stock market? Yes, but not as a mirror of reality. As a signal of where money is flowing, who owns what, who is positioned to benefit. The market tells you what the system values, not what people feel. And once Alice understands that, she stops feeling confused. She still feels stressed, but she's no longer shocked. She knows the market isn't mocking her. It's just speaking a different language, a language of capital, not of life. And that understanding changes how you listen. You stop expecting empathy from a machine and start asking harder questions. Like, why do profits recover faster than wages? Why does capital get rescued before labor? Why does ownership matter so much? Those are real questions, and they matter far more than today's green arrow. So, in conclusion, the stock market can go up even when life gets worse because it's not measuring how people are doing today, it's pricing future profits, ownership, and expectations. Markets respond to policy, interest rates, survival of big companies, and where money has the best chance to grow, not to rent prices or grocery bills. When you understand that the stock market is a forward-looking pricing machine, not a scoreboard for society, the disconnect starts to make sense. If you want me to make other videos explaining these topics, please like and subscribe. Thanks for watching.